Welcome to Sophie Daddy's channel. So today we're diving into one of Wall Street's most powerful, and let's be honest, kind of misunderstood tools, the Monte Carlo Simulation. We're going to break down how it helps quants see the future, not as just one single outcome, but as an entire universe of possibilities.
I mean, this is the question, right? It's what every investor, every bank, every hedge fund is trying to figure out. The financial markets are just this chaotic storm of unknown variables. So how on earth do you make a forecast when you're staring into that kind of uncertainty?
Well, for a long time, the old-school approach was what we call deterministic. You'd plug in your best guess for things like volatility, and you'd get one single answer. That's kind of like predicting tomorrow's weather based only on today's temperature. It just ignores everything else. But the modern way, the probabilistic model, is totally different. It embraces the randomness, and instead of giving you one answer, it maps out this whole cloud of potential futures.
And the engine that powers this whole probabilistic approach, that's the Monte Carlo simulation.
Okay, so at its heart, a Monte Carlo simulation is basically like running a financial experiment thousands or even millions of times on a computer. Instead of just one trial, you're running it over and over and over, each time with slightly different random inputs, just to see the full range of what could actually happen.
And yeah, the name itself, it's not a coincidence. It was actually coined during the Manhattan Project, and it's a direct nod to the famous casino in Monaco. It is the perfect metaphor, really, because the simulation is all about embracing chance, just like a roll of the dice, but on a massive computational scale.
And listen, this isn't some fly-by-night financial gimmick. This technique has some serious scientific street cred. It was actually developed back in the 1940s by physicists working on nuclear weapons. Then it became a staple in complex physics, long before the quants on Wall Street got their hands on it to model the markets.
So, how does this thing actually work? How do you go from a financial model to this incredibly detailed map of the future? Well, the process is actually surprisingly elegant.
It really boils down to 4 key steps. First, you build a mathematical model of whatever you're looking at. Let's say a portfolio of stocks. Second, you figure out the uncertain parts, like future returns. And instead of a single number, you define them as a range of possibilities. Step 3 is the brute force part. You just hit run and the computer simulates the model over and over, feeding it new random numbers every single time. And finally, you gather all those thousands of individual outcomes and put them together to see the big picture.
And when I say over and over, I mean it. We're talking about a massive number of runs, maybe 10,000, maybe more. And here's the key. The accuracy of your final picture is directly tied to how many times you run it. The more trials, the clearer and more reliable that map of possibilities becomes.
And this is the crucial difference. Monte Carlo doesn't just spit out the answer. It gives you the distribution of all possible answers. It shows you the most likely outcome, sure, but it also tells you the probability of everything else, from small gains all the way to catastrophic losses.
All right, so let's see how this theory translates into some serious superpowers on Wall Street. Because this isn't just a theoretical exercise. This thing has some game-changing applications in high-stakes finance.
The first superpower is its ability to find and measure the really scary stuff. You know, the worst-case scenarios. Instead of just crossing your fingers and hoping for the best, firms can use this to understand what the worst days might actually look like.
This right here is what the output actually looks like, a map of 1,000,000 possible futures for a portfolio. You can see most of the outcomes are clustered there in the middle, around the average. But look way over to the far left. That long, thin part, that's the tail. It represents those rare but incredibly damaging black swan events. Monte Carlo lets you not only see that tail, but more importantly, it lets you measure it.
So from that distribution, we get this critical risk metric called value at risk, or VAR. The easiest way to think of VAR is like drawing a line in the sand. It answers the question, okay, with 95% confidence, what is the absolute most we can expect to lose on any given day? It's that number right before the extreme tail really kicks in.
But you know, VAR has a flaw. It tells you where the bad stuff starts, but it doesn't tell you how bad it can really get. It doesn't answer that next, much more important question. When you do have one of those awful days out in the tail, what's the average loss you should brace for? And that's where conditional VAR, or CVAR, comes in. It's considered a way better metric because it doesn't just mark the edge of that tail, it actually calculates the average of all the disastrous losses inside the tail. CVAR tells you just how severe your worst-case scenarios are, which gives you a much more complete picture of your real risk.
Okay, Superpower number 2 is all about separating skill from pure dumb luck. Let's say you have a trading algorithm that did amazing for the last 5 years. How do you know it's actually good? Was the strategy robust, or did it just get incredibly lucky with one specific set of market conditions? Well, Monte Carlo can answer that by basically stress testing it against thousands of different what-if scenarios.
But, and this is a huge but, for all of its power, this model has a massive blind spot. And this leads us to something we can call the alpha dilemma. So here's the question. If this tool is so incredible at mapping out possibilities based on randomness and historical data, why can't it simulate the performance of a truly brilliant hedge fund manager who consistently crushes the market?
The answer lies in the difference between two little Greek letters, beta and alpha. Beta, that's the returns you get just for being in the market, the part driven by broad market movements and randomness. Monte Carlo is fantastic at modeling beta. But alpha? Alpha is different. That's the extra return, the outperformance that comes from real skill, from a secret edge, from exploiting some market inefficiency. And that is something the simulation simply cannot see.
See, the problem is baked into the very heart of the model's design. A standard Monte Carlo simulation is built on the fundamental assumption that markets are random and efficient. It literally has no variable for genius or informational advantage. It can only model the random walk of the market, which is beta. By its very design, it structurally excludes alpha.
So think about what this really means. The simulation can't model the unique gut feeling of a trader. It can't model someone finding and exploiting a hidden glitch in the market, and it certainly can't model the incredible impact a visionary CEO has on a company. All of these things are sources of alpha, and they all exist outside that world of random variables the simulation lives in.
So here's the bottom line, the ultimate takeaway. Monte Carlo is arguably the best tool ever invented for understanding and measuring risk, that random, unpredictable market stuff we call beta. But it is fundamentally incapable of modeling, predicting, or generating alpha. That still belongs to human insight.
Which leaves us with one last thought to chew on. As our computers and financial models get exponentially more powerful, it forces us to ask, what is the one thing they can never truly simulate? And maybe, just maybe, it's that unique spark of human skill, intuition, and ingenuity that will always remain just beyond the reach of any machine.